everyone, and welcome to another edition of the More Than Market series. My name is John Bay, Senior Vice President and Chief Investment Officer at NEI Investments and Avisa Wealth. This week, I'd like to talk to you about the yield curve, what we are seeing, and what it could mean for market participants and how NEI is positioned. So, investors are now grappling with a wall of negative news right now. The war in Ukraine, the energy crisis, surging inflation, and rising central bank rates. And in processing all of this news, they're trying to really understand what is the outlook for the economy, corporate earnings, interest rates, and capital market returns. And so one indicator that investors are increasingly turning to is the shape of the yield curve. For the shape of the yield curve can give investors clues about economic expectations, including the odds of a recession. So what is the yield curve? The yield curve, simply put, is a graphical plot of bonds of different maturities dates. The most followed yield curve is the U.S. Treasury government bond yields. So typically, the shape of the yield curve is upward sloping. This means that as you increase the date of the bond yields from 1 year to 2 year to 5 year to 10 year, the shape of the yield of those bonds typically increases. This is because as you extend the maturity date, risks for the investors increase. And so longer term investors demand more compensation in what we call term premia. But there are times in the economic cycle when the spread between longer term yields, such as the 10-year yield, and shorter term yields begin to narrow. And we call this a flattening of the yield curve. This is because short-term yields are more sensitive to central bank rates, and longer-term yields are more sensitive to economic growth and inflation expectations. So when we reach a point where short-term yields are actually higher than long-term yields, investors are signaling that central bank rates are at a high enough point that it will drive down economic growth to a point where we're entering a recession. So where are we today? As we know, central banks have shifted their focus dramatically in 2022. Last year, it was all about the economic recovery and getting the labor market to full employment. This year, it's now focused on combating inflation. As a result, the Federal Reserve has signaled that they're going to be more aggressive in raising short-term rates to combat inflation. And this has led to a tripling of short-term rates. For instance, the 2-year yield started the yield at 75 basis points. It's now sitting around 2.25. And this has led to a dramatic flattening of the curve. And right now, we currently sit about 25 basis points away from an inverted yield curve. So do we expect the yield curve to invert? Well, right now, it's not clear to us that it will actually invert, but we certainly believe that the curve will remain flat. We don't believe, importantly, we don't believe that we've reached a point where central bankers, including the Fed, will need to drive the economy into a recession in order to push inflation rates and expectations lower. As a result, we believe the US economy is strong enough to withstand higher rates without entering a contraction. However, of course, the level of uncertainty is extremely high, given the war in Ukraine, the ongoing pandemic, supply chain issues, and other factors. And as a result, we're going to have to monitor events closely. So while the risks of a recession have gone up, recession is still not our base case scenario for 2023. The US economy is still strong as consumers break out of the COVID-induced lockdowns. Consumer savings are still high, leading indicators are still strong, and US reliance on oil is certainly lower than the 1970s and 80s oil shocks. And importantly, the work by the Federal Reserve also suggests that the shorter end of the curve is more predictive of US recessions. And that end of the curve is actually still steepening, indicating that a recession is not on the horizon. So how are our portfolios positioned? A combination of rate hiking cycle and higher inflation means that volatility in stock and bond market portfolios, in our opinion, will remain elevated. NEI is continuing to take measures in our positioning of our portfolios, including reducing risk levels. We are decreasing exposure to high yield bonds in our bond portfolio. We're decreasing exposure to emerging markets in our equity portfolios, for instance. We're also increasing quality. We're focused on developed markets, particularly North America. And for now, avoid adding exposure to emerging markets and Europe. And we're definitely favoring larger cap, more defensive sectors, and focusing on active managers that have high quality, low volatility investment styles. In our bond portfolios, we have emphasized managers, for instance, in our total return bond portfolio, that are not dependent on changes in interest rates for returns, but are more absolute-like returns and have positioned actively for this backup in interest rates, and therefore are able to add value in other ways, for instance, playing the shape of the yield curve. So individual sub-managers are taking measures to position in this environment, and we continue to actively monitor our portfolio. Some things that investors can do to deal with volatile markets include stay invested, stay diversified, and use volatility to your advantage. And using, for instance, a dollar cost averaging strategy that can be great ways to gradually increase your exposure investments that are right for you. So with that, I hope you enjoyed today's update. As always, do not hesitate to reach out to your NEI representative if you have any questions or are looking for tools to help you in your client conversations. Thank you so much for tuning in. We hope you found today's discussion helpful, and watch out for next week's edition of the More Than Market series.